Welcome to the deep dive. So today we're jumping into that stack of Maruti Suzuki documents you've probably got piled, Q2 financials, the analyst call, those October sales figures.
Right. And our job, really, is to make sense of it all. How did MSIL handle, well, a pretty weird quarter?
Exactly. It's paradoxical, isn't it? Domestic sales took a hit, but net sales and profit actually went up, and exports just went through the roof.
Yeah, it's definitely a tangled story at first glance.
Okay, let's unpack this. Let's start with the core numbers, the Q2 financials.
Okay, so total sales volume, just under 551,000 units. That's up slightly, about 1.7% year on year.
Marginal increase, yeah. But then net sales that jumped nearly 13%, hitting over 401 billion rupees.
Which is pretty significant. And the bottom line, the profit after tax, or PPA, that grew too by 7.3%.
So that volume number versus the revenue number. That's the puzzle, right? How does volume barely move, but sales jump so much?
Well, according to management, that domestic sales dipped down 5.1% wasn't, real market weakness.
What do you mean not real?
They put it down squarely to customers hitting pause, just waiting.
Waiting for what?
The GST reform. Everyone sort of knew a price cut was probably coming for smaller cars, especially after mid-August discussions intensified. So people just decided, okay, let's hold off buying until September 22nd when the policy actually changed.
Ah, okay. So domestic volume slowed down because people were waiting for cheaper prices.
Right. But the cars they were selling, maybe a richer mix, plus price increases earlier in the year, helped push up the revenue value, even on lower domestic units. Inventory was moving slower domestically, too.
But if domestic demand was artificially suppressed like that, something must have picked up the slack to keep profits growing.
Absolutely. And that was exports. It was the critical safety net for the quarter.
How critical?
Record-breaking critical. They shipped over 110,000 units internationally.
Yeah.
That's the highest quarterly export number they've ever had. Yeah, a massive 42.2% increase compared to the same quarter last year. That huge export volume, combined with maybe a better mix overall, is what really drove those net sales and profit figures up, despite the domestic lull.
Okay, that makes sense. But let's get into the margins, because that tells a slightly tougher story, doesn't it?
Yeah.
Operating EBIT margin was 8.5% in Q2.
Which, in isolation isn't terrible, but yeah, compared to last year.
Last year's Q2 was 10.3%. So that's a drop of 180 basis points. That's quite a squeeze. What hit them?
It was a few things hitting at once. First, ongoing pressure from commodity prices. Still a factor. And foreign exchange wasn't helping either. They specifically mentioned the strong Japanese yen against the rupee.
Right, for imported components.
Exactly. Second, higher spending. More on sales promotions, discounts, and also some price adjustments to stay competitive in certain segments. And then a big one. Depreciation charges were up.
Why was that?
Two main reasons. The big new Carcosa manufacturing plant is starting to come online, so you get depreciation from that massive investment. Plus, you had major launches like the Victorious SUV, which also adds to depreciation costs. These things add up and ate into that margin.
Okay, so year over year, the pressure was definitely on. But what's fascinating here, how the strong sequential operational leverage managed to stabilize margins despite major price pressures.
Right.
Because they actually improved slightly from Q1 to Q2, right? From 8.3% up to 8.5%.
Yeah, that 20 basis point sequential rise is interesting. It shows they were fighting hard on the operational side.
How do they pull that off with all those cost headwinds?
Primarily through operational leverage. As volumes ramped up overall, especially with exports, those fixed costs get spread thinner. That gave them about 110 basis points back.
Yep.
And they also managed to trim other operating expenses, finding another 50 basis points of savings there. So real focus on internal efficiency.
So internal gains canceling out some external pain?
Pretty much. They still had to swallow the cost increases, like 75 basis points more for sales promotions and another 20 for those price corrections we mentioned. But without those operational improvements, the margin would likely have slipped quarter on quarter.
Got it. There was something else mentioned too, non-operating income.
Yes, that was lower too. It was mainly due to a mark-to-market impact on their investments.
Can you quickly explain mark-to-market for us?
Sure. So MSIL holds surplus cash, often in things like bonds. Interest rates, or bond yields, have been rising. Hardening is the term they used. When yields go up, the market value of existing bonds with lower rates goes down.
Okay.
So accounting rules mean they have to recognize that potential loss on paper, even if they don't sell the bonds. It dragged down the non-operating income line, impacting the final net profit figure slightly. It's not core business performance, but it shows up in the numbers.
So operationally, they were really battling just to maintain that margin level sequentially.
Exactly. A tough fight.
Right, let's shift gears to what happened after September 22nd, when that GST change finally kicked in. Because it sounds like the floodgates opened.
That's a good way to put it. Management used the word buoyancy. Suddenly, all that pent-up demand was unleashed. Activity just surged.
And the festive season numbers really show that, don't they? Looking at that period from late September through October.
Yeah, absolutely. Here's where it gets really interesting. Look at bookings. They shot up to 500,000 during that festive window. Compare that to 350,000 the year before.
Huge jump. And retails, actual cars leaving the showrooms.
Even more dramatic. 400,000 retail sales. The previous year, in the same period, 211,000. It almost doubled.
Wow. Just wow. And was this across the board, or did the GST cut have a specific effect?
Very specific. Remember, the cut was aimed at smaller cars, those in the 18% GST bracket?
Right.
Well, of those 400,000 retails, 250,000 were from that exact small car segment. That's basically 100% growth for small cars during the festive rush. Proof the policy worked, you could say.
That's incredible. And it must have shifted their sales mix quite a bit.
Instantly. The share of small cars in their total sales jumped from around 16.5% before the change right up to 20.5% afterwards. So, yeah, the policy didn't just boost overall sales, it really revitalized a segment that's historically been their bread and butter.
And that retail demand immediately put pressure back on the factories.
Yeah.
October sounds like it was frantic.
Absolutely. That retail surge fed straight into wholesale demand. October 2025 became their best month ever.
Best ever for what?
For everything, practically. Highest ever total monthly sales volume, over 220,000 units, and highest ever domestic sales in a single month, too. Just record numbers across the board.
And you mentioned the pressure on production.
Yeah, the internal notes mentioned production teams having to work, I think it was 3 Sundays now, and probably will need to work at least 1 more Sunday, just struggling to keep up.
Imagine that whiplash. From customers waiting to suddenly needing weekend shifts just to meet orders.
It really speaks to how much demand was just sitting there waiting for the trigger, and even with those record sales, inventory was apparently still tight. It was around 38 days worth at the end of September, but likely much lower by the end of October.
And they still have a backlog.
Yep. Still around 200,000 pending bookings as they headed into November, so the demand is still very much there.
Okay, let's connect this short-term boom to the longer-term strategy. All this activity needs to feed into their bigger goals, especially around SUVs, right?
Definitely. The new product launches are key here. Look at the Victorious SUV. They mentioned remarkable excitement around its launch.
How many bookings did it get?
Over 30,000 pretty quickly. But beyond the numbers, they really hammered the features. Level 2 ADS, the strong hybrid option, 4x4 CNG, and, critically, safety.
Ah, yes, the safety angle. That seems increasingly important.
Paramount, I'd say. Both the Victorious and the Invictor MPV secured a 5-star rating under the new PARAD NCIP safety tests. That's a huge deal for them.
Why huge? Hasn't safety been a point of discussion for Maruti in the past?
Exactly. This is them directly addressing that historical perception. Getting top marks on their big new flagship models sends a very clear message that safety is now a core focus. It helps change the narrative around the brand.
And it seems their existing SUV, the Grand Vitara, is still performing well, too.
Very well. Hit 300,000 sales in just 32 months. So the SUV push is clearly gaining traction, but the ambition isn't just domestic.
Right, the export story continues.
Big time. They're positioning India as a major global manufacturing base. Production has started for their first EV, the e-Vitara, specifically for export.
Where's it going?
Over 100 countries eventually, including places like Europe and Japan. They've already shipped over 7,000 units, mostly to Europe. That's a significant step into the global EV market.
And other models are being exported heavily, too.
Yeah, the Franx crossover and the Jimny 5-door SUV, which are both made only in India, have each crossed 100,000 cumulative export units. That's huge validation for their Indian manufacturing capabilities.
Which all leads back to that really ambitious target set by the top brass at Suzuki Motor Corp.
Yes. The global president was very clear. The goal is 50% market share in India.
50%. That's ambitious in today's market.
Extremely ambitious. And alongside that, a 10% operating EBIT margin. If we connect this to the bigger picture, hitting 50% share when the market is getting more crowded with competitors, it's a massive challenge. They acknowledged how tough it will be.
So what's the main strategy to even attempt that? How do they plan to get there?
More SUVs. Lots more SUVs. The plan revealed is to launch 8 additional new SUV models in India by around 2030-31.
8 more. On top of Victorious and the Evitara.
Exactly, incremental to those. It's a full-on product offensive aimed squarely at the fastest-growing segment of the market. They're betting that a flood of new, modern, safe SUVs is the way to capture that share.
Okay, so the product plan is aggressive, but the sources also highlighted a couple of other things. A corporate structure change and a big regulatory question mark.
Right. On the structure side, the merger or amalgamation of MSIL with Suzuki Motor Gujarat, which is their wholly owned subsidiary running the Gujarat plant, seems to be proceeding smoothly. The first motion was approved back in June.
And the second.
The tribunal heard the final confirmation petition in October and reserved its judgment. So it looks like that's mostly an administrative process nearing completion.
But the other point, the regulatory one, sounded more complicated, the ELV rules.
Ah, yes. The Environment Protection End-of-Life Vehicles Rules 2025. This was a major flag raised by the auditors. And it's tricky.
Why tricky? The rules are in effect, right, since April 2025.
They are. And they place what's called Extended Producer Responsibility, or EPR, onto manufacturers like Maruti.
Okay, what does EPR mean in simple terms?
It means Maruti is legally on the hook for making sure a certain number of their old cars' vehicles reaching end of life get properly scrapped or recycled. They have to prove they've met their target.
How do they prove it?
By buying EPR certificates. Think of them like recycling credits. They need to acquire enough certificates to cover their obligation.
So what does this all mean? It sounds like a defined cost they need to account for.
That's the problem. It should be a defined cost, but it isn't, not yet.
Why not?
Because the government hasn't actually set up the system to make it work. The auditors pointed out there's no central online portal operational yet. Producers like Maruti can't officially register. The vendors who would issue certificates aren't registered, and crucially...
Let me guess, no one knows how much these certificates will cost.
Exactly. There's no pricing mechanism defined,
Okay.
no agreed way to measure compliance properly. So Maruti knows they have this potentially significant financial obligation looming, mandated by law, but they have absolutely no reliable way to estimate how much it will actually cost them.
So they can't even put a provision in their accounts for it.
Precisely. The auditors highlighted this inability to reliably estimate the financial impact. It's a known unknown, a regulatory black box hanging over them.
Okay, so wrapping this up, this deep dive really shows a company, MSIL, that navigated Q2 with quite a bit of operational skill. Exports were the absolute lifeline against that weird domestic policy situation.
Definitely. And then the GST cut just opened the taps. Huge retail surge, especially bringing life back into that vital small car segment.
Right. And while margins were under pressure year on year, they managed to hold the line sequentially through efficiency gains. And the forward strategy is crystal clear. Flood the market with SUVs to chase that 50% share and 10% margin goal.
But, and it's a big but, that final point about the ELV rules really sticks out. You have this very ambitious, very clear corporate strategy aiming for high profitability.
A 10% EBIT target.
Exactly. And colliding with that strategy is this major regulatory uncertainty, a potentially large mandatory cost that is already legally in effect but is completely unquantifiable right now because the government infrastructure isn't built.
So the final thought for you, the listener, is this. How does a company realistically plan for and budget towards a demanding 10% margin target when a significant unavoidable future cost may? The ELV obligation remains a complete black box. That tension between strategic ambition and regulatory fog is going to be fascinating to watch play out for Maruti Suzuki.